Good evening, everybody. Okay, what we're going to do is kind of do a little bit of a backwards move on how we can use, not backwards move, just kind of a review on how we use option strategies, different option strategies that make sense when using candlestick signals. So essentially, we're going to use spreads. Kind of spreads where you put on a position where you're buying and selling an equal number of options in the same class. In the same underlying security, but at different strike prices. Well, that's a fine howdy do. So the first thing that we have as an advantage when we're trading candlesticks is we've got signals that tell us the direction of a move with a high degree of probability. Then we got situations that show the timeliness of that move. And then we've got potential targets based upon different criteria, like where the stochastics are and the strength of the signal, to tell us where our next likely target's going to be. And depending on what software you use, for example, you can set up your scanning software with Thinkorswim, where you can set up your parameters and then come up with a list of stocks that fit those parameters. So if I want to narrow it right down to a specific signal, I forget which one this one was, or I may just do a general scan for stocks that had big percent moves on any particular day. Or if I'm looking for a specific signal, like a left-right combo, it allows me to find those signals and put me in the right trades at the right time. Now, the important factor is, once I find the right trade at the right time, I want to be able to take advantage of that. So I've got some relevant decisions to make as far as options. How far out do I want to go to the expiration? What strike price or what combination of those two is the best one for what we're looking for? So that's all going to be based upon the timing and the targets. Now, I've got kind of a strategy set up where if I'm buying calls or puts outright on a trade, I probably want to go 3 or 4 weeks out because I don't want to do a spread. I usually do a debit spread somewhere between 2 and 3 weeks out. Now, the reason that's a shorter time span is because let's say we get lucky. Not lucky, maybe, let's put it this way. Let's say our analysis worked the way we expected it to, but the price moves a lot greater than what we wanted it to or what we expected it to. If we've done a spread where we sold bought the 50s and sold the 55 call spread because we anticipated the price move would go to 55, let's say the next 2 weeks, let's say hypothetically over the next 4 days, it goes to 62. What does that do to our spread? Well, more than likely, the 55s, because they're closer to being at the money, much closer obviously than the 50, that's probably going to move up faster percentage-wise than the 50s. So even though we've got a very good trade, you may have to sit in it for a while because the one price moved faster than the other. If we paid $2 for that spread, it may be at 160 just because of the difference between the two strike prices have moved on the 55 much faster. So I try to keep the debit spreads somewhere around 2 to 3 weeks out because the closer you get to expiration date, the closer to that, whatever your spread is. If it's a $5 spread, you bought the 50s and sold the 55s, it's going to be at 5 if it's above 55 on expiration day, just the difference between the two. I do credit spreads, usually on a much shorter time frame. Like if we can see that the market or the price of the stock is heading up, but not very much further up, maybe we're much better off doing a credit spread. So if we can kind of estimate what our time frame might be, that's how we project which trade is the best. But anytime we put on an option trade, we're doing it on one very primary aspect, and that is which one has the math that makes the most sense. People that are usually new at option trading would say, oh, that stock's going up, I'm going to buy the calls. That may not be your best trade, because by the time you pay the premium and the bid-ask spread, and that price has to move to get back to break even on your trade as well as make money. Maybe a spread is much more sensible. So the benefit we have with different strategies, if we know what wave 1 is, and our J-hook pattern is creating wave 3, we can decide what type of spread we might want to do if it's going to go to our target. Or if we can see what our target is. Moving from here up to the 200. And I use this as an example. If we were buying the March 17 calls at $9.30 and it goes to $17.30 by expiration, our $9.30 has gone to $30. So when I say why is a spread versus a straight call position much better, the math and the risk. Because if we do the math, if we buy those calls for $9.30 and it goes to what do they say, $17.30, that's a $20.70 profit, or 222%. But if we bought the call spread of $1,700 and sold the 1710s for $1.80, first of all, that price doesn't have to nearly go up as much. All it has to do is go up to the 1710, and our 180 goes to $10, or a much bigger percentage return. Or the other way to look at it is, if we bought the calls to make the same return on a spread that only needed to go to 1710, the same return would be made by buying the calls outright if the price would have to go up to 1751 or up in this range to make the same return as a call spread. So our other factor is how far out do we want to go? We can always go figure out how many days we can calculate to go to our target price. Now, here's a strategy that we're showing people, which I call option combination strategies. If a pattern price target, we can identify where it might go to and have big profits, we might do a combination where we buy the calls, and then somewhere up into that trade, we do call spreads, or a call spread. So if this is a 15-point move and we expected it to move up here, we might be buying the calls 4 weeks out, and we might be doing a call spread 2 weeks out. Now, what does that do for you? Oh, here's a long list of that. If the spread, or if the price goes to our target, we've made some very good money. If the price move only kind of comes up here and fizzles, the spread makes a decent rate of return. And even though the calls outright may only make the spread has kind of offset or added to that profitability. So remember, it's the math. Once we identify which signals or patterns do we want to go after. If we have a good pattern expectation, or, darn, we've gone through the slides pretty much already, or this is what we can do as far as getting some huge returns. If we saw a bearish engulfing in the overbought condition followed by a doji, what would we expect to happen after the doji? What's our doji rule? Would be a reversal. All right. There you go. Brad had it right. Bearish doji sandwich, or maybe a J or a Morningstar type signal. So let's say hypothetically we thought the market was heading lower, and we look at the September 27 puts. But if this price opens lower, what type of signal do we have? Yeah, we've got a bearish doji sandwich. Where would you expect it to move to? Down here to the 50. So if it opened lower, like it did today, and traded lower, we've got people in the options room that trade those where the September 13 puts could be bought at 6 cents this morning, and they closed at 53 cents. Huge profits. And why was that feasible? Because we knew what to expect after if it opened weaker. And then we had a logical target. Now, is that a high-risk trade setup? Certainly is. But if you've got 6 cents, I'm just going to pick out a figure. Let's say you bought 100 for $600. At the end of the day, you were at 5,300. So what we can do based upon candlestick signals and patterns is figure out the best trade setup. Roku did a big bearish engulfing signal, had all the elements of a reversal. Where do most people buy? They buy exuberantly at the top. We recognize that when it gapped up here. The fact that they open it lower, if we're buying the puts, how long do we hold on to the puts? Well, if we could recognize that this might be our first target, we might be buying puts outright in case it doesn't support at the first logical support level, or I probably should say and buy a put spread. That if it came down through here, you've got some big profits, or if even it came down moderately somewhere in here, the profitability of that spread would help enhance the returns of the puts outright. So why is a combination of a spread and outright puts, in this case, viable? Because if we thought this was our target and we could do a spread that would be profitable, well, what would happen if it went down further, let's say to the next support level? Well, obviously, we're going to be limited to our profitability on the spread, but then the puts in the remaining position increase our profits. Or recognizing a left-right combo like we saw in SPB, and they gap down, what did that imply? This could be our first target. This could be our first target. We could be buying puts and put spreads to enhance your risk return, risk reward, and kind of modifying your the price move to still make a good profit. So anytime we can see a potential trade, Sting is our recommendation for tomorrow. How do you determine targets? Based upon a wave 1, wave 2, wave 3 being the same magnitude as wave 1, or if we can see what everybody else is watching. But if it came down through there, where do you think our first likely target's going to be? Back to the 50. What we're using as targets is anything that we can recognize that everybody else is watching. The advantage we have, though, is being able to identify what type of signals are occurring right at a target. For example, Barry's engulfing, Barry's doji sandwich, where do you think the next target was going to be? The 50. Was it going to support at the 50? We don't know, but yesterday it did a bullish harami doji. What'd that tell us? If it opened positive, our harami was telling the selling has stopped, get ready to start. So the visual aspects of candlesticks, we have a much greater advantage for recognizing what type of patterns. There's our bobble breakout. There's our sell signal. There's our Barry's doji sandwich. There's our bullish harami best friend gap up. What can we anticipate? Well, at least the prospect of a wave 1, wave 2, wave 3. So before we go to the live charts, again, what's the advantage of our candlestick analysis? We can pretty much identify with a high degree of probability the direction of a move, the timeliness of the move, because we can see exactly when that reversal has occurred, and then we can kind of calculate the magnitude of the move based upon what the next targets might be. And what everybody else is watching based upon moving averages or wave 3 of a J-hook pattern or a breakout of a fry pan bottom. So because we can improve the probabilities, and a lot of people don't want to try to trade or try to figure out the best option strategies themselves, you might try the Pivotal Cash Bonanzas program. That's where they identify, or mostly me, identify what price or what chart we might want to be going after. And then they've got much more expertise in calculating what are the best calls or what's the best position to be putting on that trade. So I don't want to say it was the Scholes, Blackman Scholes. I forget the name now, Scholes. But they've got programs to say, all right, we got a bullish engulfing signal or a best friend signal. Here's the most viable trade. It might be 3 weeks out, and it might be in the money, or it might be 4 weeks out and out of the money. They have the calculation. I am usually, I've given them the formulas, but most of the time I am sending over I say most of the time, a good percentage of the time, I'm sending over the option recommendations. So anyways, whoops, okay, yeah, Becky's put in the software. So this is a program where you may not want to immediately try to pick out the best option strategies for yourself. Because of the analysis of what we consider the best reversals or the best trade setups, they've got the software to pick out the best strike price or the best expiration date. But that should be only part of your option trading portfolio. In the options room, we get a little bit more, you're going to have a little bit more information in the options room, and that is where you're going to get different strategies. We got a couple traders in there that are extremely good for setting up different strategies based upon the amount of time we have left in the market for a trend and the signal or pattern. Okay, so with that, let's go to some live charts. do this correctly. There we go. Okay. All right, so this is what we're looking at for a good recommendation tomorrow. Bing, Scorpio tankers, because of the best friend signal right off the 50 with stochastics coming up. At least we can calculate that our first target might be here. Second target, same magnitude as this, taking us up into the, let's say, the $37, $38 area. Okay, so where's my list? All right, so here's our analysis of the market, or what our analysis should be of the market. Which way is the Dow going right now? No earthly idea. And the reason for that is obviously it's moving sideways. We got up days, down days, up days, down days. So when you put on a trade right now, yes, it's pretty much news oriented. We don't know whether tomorrow things look bad in Washington, it's going this way, or things look good in Washington, it's going this way, or things look bad and good, still trading sideways. Now, the nature of the market, if I can make this small enough, usually what we can do is pretty much calculate that when we hit a bottom, it moves up. And then when it hits a top, it moves down. But that's right, it always goes my way. But notice what's happening here recently. When it gets up to a top, it moves sideways. Makes it very difficult to figure out whether to be long or short. Moves down. We can see when that happened. But then what happened? Not only did it move sideways, but it whipsawed something terrible. You couldn't do anything one way or the other. Now it moved back up. Now it's moving sideways. I have no idea which way it's going to go from here. So what this is doing, and this is kind of the hardest part of investing, especially when you want to be trading or have your money in something, is there's times now where you just have to say, I don't know what's going on here. Let's sit on the sidelines for a little bit. But there are different charts out there that still work. Look at VC. You can see the pattern setup, and look at our belt hold. Oh, I can't even remember which one's. Darn. Always remember to write down. So this one has a high probability of what can we kind of see as a trend possibility. Kind of this trend channel. It looks like this. Where do you think our next target's likely going to be? Up here somewhere. If that's our target, and I'm going to just kind of say close to 95, but maybe an 85-90 spread is viable, and maybe buying the 80 calls is viable. Let's say this time it does go through this level. Now remember, the disadvantage of a spread is if this stock goes up here, which very rarely do they explode like that, but if you bought the calls, you made good money on the calls, but you were limited on your profitability on the spread. But a spread becomes more effective if, let's say, it only moves up into here. Well, now you've made very good money with a spread, probably a much bigger percentage than what you would have just with a call alone. So we've got some positions on right now that are working well. Look at Senta, our bobble breakout. Want to just stay long. And look where we are right now. Right about the same level we topped out before. If this opens positive tomorrow, what do we got going on? Well, we already know we have a bobble breakout. We already can calculate that here's wave 1. Wave 3 should take us up here. If it opens positive, we got a doji sandwich with a price move of this same magnitude. Maybe you buy some calls at that point. If it does confirm and you know there's going to be more upside, then maybe you add a call spread up here. So, again, the whole point of taking advantage of a price move is that we can put on the different strategies that reduce our risk but maximize our return. Neil, it's very simple. If, let's say in this 30s, and we sold the 32.50, so there's a difference of the $2.50. I'm just going to say hypothetically, let's say if you bought the 30s and sold the 32s, you paid, I'm going to say 65 cents for it. I'm just picking out a number. Now, if it goes to 32 on expiration date, you've sold the 32s, I'm sorry, the 32.50s, you bought the 30s. On expiration day, if it's trading at 32.50, how much are your 30s worth? $2.50, right? So you can sell those for $2.50. But you've sold the 32.50s and had put money in your pocket to reduce the price of that spread. But on expiration date, if it's trading at 32.50, how much are they worth? Zero. So you're buying or you're selling your 30s for $32.50 or for $2.50. You don't have to pay anything to buy back your 32.50s. So you've made $2.50. That's the maximum you can make on that trade. Now, if the stock price goes to 35, what's the maximum you can make on that trade? Well, you can sell your 30s for $5, but you've got to buy back your 32.50s that you sold for $2.50. So your price, your maximum profitability is $2.50, the difference between those two. Is that understandable? Okay. So we recommended Fran today. It didn't execute. Well, we got kind of a Morningstar signal and a doji. If this opens positive, a J-hook pattern, where do you think our first target is? Right about here. Where's our second target? Well, if this is wave one, about 14 points, 14 points from here takes you into about the the $27 range. So there's two major concepts of candlestick analysis. It tells us when there's a change of investor sentiment. We can use the T-line to tell us our new trend is in progress. We have viable targets. But there's also a simple analysis, too, that if we've got a good buy signal, it also tells us when to be back out of that trade, that it didn't work. So most investors, I say most investors, which I put myself in that category. If I saw a good trade and it backed off, I'd say, oh, man, it was a good trade. I'm going to wait for it to come back. What you are hoping for has nothing to do with what the chart is telling you. A bad trade, you close it out. I now can expect probably a better percentage of correct trades than most any other technical trading program. Candlesticks are very accurate as far as telling us what's going on in investor sentiment. Much more accurate than I've seen in any other trading method. But I can pretty much calculate that 1 out of every 3 of my trades is not going to work. Now, that still means, oh man, 2 out of every 3 trades you're going to make is going to make you money. You should make a fortune. Yes, if you know what to do with the 33 that don't work, which is you close out bad trades quickly and then move on to something that's good. Do you look at other things besides candlesticks? Santa looks overbought on stochastics and hitting the upper Bollinger Bands. Wouldn't these things indicate it's more likely to decline? Jake Santa. My number one criteria is analyze what the pattern is. In this case, the pattern was a very high probability pattern. This is what we call a bobble breakout, which is nothing more than a J-hook pattern that has a very visible resistance level and breakout level. So if you took out the 200-day moving average, you'd still have a J-hook pattern. So we already know that wave 1 and wave 3 should be about the same. Now, whatever else you want to add to it, Bollinger Bands, or you're in the overbought condition, but remember, patterns are usually going to break out when they're in the overbought condition. Signals are usually going to be more effective when they're in the oversold condition. So I would be buying, or we did buy this based upon recognizing that bobble breakout. Yes. So, but if you, I use the criteria of the candlestick signals and patterns as my number one criteria. Then you can add anything else you want to on the chart to see whether they're confirming or not. Now, the combination of the signals, patterns, and the T-line has been such an effective combination for me. That's why you see such simplicity on these charts. So I have expectations of what the pattern's going to do. But that doesn't keep me from saying, all right, well, maybe we're right at a breakout level. If it fails here, what's it telling me? Well, that this resistance level is probably acting as resistance. It didn't break out. If it does break out, what's it telling me about my bobble? Well, I've got a high probability we're in wave 3. Okay, so again, if I've got a good pattern or signal, I also want to be aware that if I'm buying our best friend signal off the 50, where should I expect it to be going? This way. What's my stop? At this point, it shouldn't close back below the T-line. A buy signal in an uptrend is not an entry. No, unless it's in a pattern. Notice right here, we had a doji sandwich breakout. Gave us at least another good trade. And it was right up here in the overbought condition. MDCO. Well, it was a little bit more, more resilient earlier, but you can see how they gapped up through the resistance level. This one can probably still be bought, especially if it came back up through today's high, because essentially you'd have a wave 1, wave 2. Now look how they broke out into wave 3. They gapped up and started that uptrend. Oh, I know what this was. I'm partially colorblind, which shows you I don't want to riding around. I'm colorblind with reds and greens, which you don't want to be riding around with me through stop signs in the trees. But if this opens positive, we got basically kind of a bullish flutter kicker signal. Newell. We can see what type of pattern setup we've got. There's your J-hook pattern. There's kind of your double doji sandwich. You can still be buying this one, and then especially if it comes up through this level, what can we expect? Wave 1, wave. Yes. Remember, these price movements aren't based upon anything other than these price movements have worked for the last 400 years, and that's why the Japanese rice traders have identified and pointed them out and told us which signals and patterns are the strongest, because that's the way human nature works. The last two candles on MDCO look the same as the last two candles on Boeing. Pretty much, yes. But Boeing has a different little pattern. It's kind of your little scoop pattern. And notice how we can identify this as a more resilient chart. Look what happened right here on the T-line. Is there an expected target? Yes. If it broke out, if this went from 1575 to, I'm going to just say 1875, 3 points. 3 points from here takes us up into the $21 area. Wave 1, wave 2, wave 3, the same as wave 1. Now, will it get there? I don't know, but if it starts confirming, that's kind of our expectation. What is the most important factor of telling us it's hit its peak? If it moves up here and does a sell signal anywhere in here, that tells us it's time to come back out. The signal and the pattern are the important criteria. Here's Goodyear. Here's our classic, fry pan bottom, J-hook pattern. Where do you think the next likely target's going to be? Wave 1, wave 3 up to the 200. ENB, wave 1, wave 2. Where do we expect wave 3? Same magnitude as this. Goodyear, well, yeah, kind of a rounded bottom J-hook pattern. RM, true. That's the projected target. Because if you're seeing it support down here after it broke through the 50, what's everybody watching? They're watching to see whether that's your next target. If you're a seller and you see it start moving up, what are you inclined to do? Are you inclined to hold on to it to see if it's going to get to the 200? That means there's less selling incentive as it's moving higher. Here's another breakout. And how did this bubble breakout occur? With a gap up after a bullish Harami. What's our next likely target? Wave 1, wave 3 up here somewhere. What one was that? So the reason I'm pointing this out is even though the market doesn't look like it's very enthusiastic for a trend, always come back to the numbers. There's 10,000 trading entities out there. On any given day, simple candlestick scans are going to provide, even on bad days, 3, 5, 7, 10, 12 good charts on the bullish side. Or 3, 5, 10, 12 good bearish charts. So depending on what you think the market, or you don't know what the market's going to do tomorrow, but let's say hypothetically we wake up and the pre-market futures are showing that the market's going to open down 80 points. Where's our likely target still? Back down here. That means I've already scanned tonight for bullish charts and bearish charts. Kind of a bearish doji sandwich. If the market opened lower tomorrow, might be shorting free because you got the sell signals and the market's kind of pushing it in that direction. If the market opens higher, might be going after one of my bullish charts. So right now, we're predominantly short only because the long positions have all stopped out, but the short positions are still lots of good shorts. We recommended shorting SONO today because rounded top or the dumpling top, and then the gap down. Where do we think our next target's likely to be? Right here. Where's our next target? There's a little gap right here. So remember what this tells us. Lots of indecision. Now they're starting to make the decisions based upon the sell signals. We've been short where we put spreads on here. Where's the logical analysis of this one? A doji in the overbought condition. Just as it hit the 200. Opens lower the next day. What can we be doing? We can either, if we're long, we're closing out positions. When it came down through this level, we can be going short. What's our criteria for staying short? Stay short until you see a buy signal and a close back up above the T line. DECK. Let's get rid of these. Right here at the 50. Kind of a bearish doji sandwich. How long would you stay short on this one? Until you see a buy signal. Not necessarily a close back up above the T line, but what's our little caveat about the T line? The further you move away from the T line, the higher the probability it's going to come back up and test it. So if we saw a hammer signal tomorrow down here in the oversold area, yeah, we might start taking some of this off. That was kind of the same rationale where we were in puts on GM, but look what we saw on GM. Not a signal here, but we had a bullish harami here at the same level and saw some buying. That was a good time to start closing out the puts because you were getting toward the oversold area and you were seeing some buying. Not anything more than just simple logic to say, all right, what signals are setting up based upon the implication or the infusion of either bullish sentiment or bearish sentiment. There's our evening star type signal, doji, double doji gap down. Where did it break through? Kind of this level. What's this tell us? Maybe we're in wave 1, wave 2, now going into wave 3. Okay. And so, if we can recognize the strongest sell signals, Carnival, bearish kicker signal, where do we anticipate the next likely target could be? By the bottom of that trend. Why? Because your kicker signal is one of your strongest reversal signals. ENPH. What is this pattern? There's our blue ice failure. As my late friend Dave Elliott described as somebody falling through the ice. They come up to try to find the hole they fell through. They can't find it. They drown. Where do they go? To the bottom of the pond. Or bearish wave 1, wave 2, wave 3. And for you new folks, I was always very helpful to Dave when we used to do big trainings across the United States. So I would help help people remember his blue ice failure by saying, how do you catch a polar bear? Well, you cut a big hole in the ice, and then you take a can of peas and you spread that can of peas around the hole. And when the polar bear comes down to take a pee, you kick him in the ice hole. It wasn't a real technical evaluation, but people remember the blue ice failure. So look what we've got here. Doji, kind of evening star signal closed below the T line. Now we've got a bearish doji sandwich. That could be your next likely target. QURE. What do you think this one's doing? There's your dumpling top. There's your breakdown. There's probably your next target. And what can we assume this chart is doing? It's already in a downtrend, and every time it comes up to the T line, they start selling it off again. So if we see something like this, and we know the probabilities are pretty strong that it's heading lower, but the magnitude of the move may not be very great, maybe we do something like, I don't know if they have them, but let's say a 20, 28, 26 or put spread. Well, the return on that is much greater than just buying the puts. It's not going to move very far. Where you might have puts that you could make a, let's say, 100% profit if it came down here, doing the put spread, you might be at a 275% profit, which also does a couple other things for you. First of all, the break even is not as far as just buying the puts outright, and you've got less money exposed to the trade, and your percentage return will be that much greater. Do you always use a daily chart? No. Ernie, this could be a daily chart, a weekly or monthly. It could be a 5-minute chart, 10-minute chart, 30-minute chart. It all depends on the time frame that you want to trade. I'm I'm a swing trader, so I'm trading stocks that usually the positions last anywhere from 2 to 10 trading days. If I'm trading intraday, I might be trading soybeans. That's not a good chart to illustrate. Let's see if I can find. This is after hours. So I might look at this bobble breakout on wheat. But if I was trading this positive today, I'm probably trading it off the 10-minute chart. So it might be that I'm trading here, and so this is a 10-minute chart. Looks just the same as a daily chart. VAC. Where's the next likely target? Down here at the 50. It might not be that big a percent move, but it might be an excellent spread trade. EQ. There's your berry stogie sandwich sitting right here on the 50. What's that tell us? Well, if they open it lower, it's telling us the berry stogie sandwich is working, and the 50 is probably not working. We might be heading back down here toward the 200. So we can make some very simple conclusions based upon the strength of a signal, where it's sitting. If it breaches that level, or if it traded positive, it would be probably telling us, all right, they're supporting here at the 50. You don't want to be going short. Yes, and that's, you could always do a whatever strategy. And again, the credit spreads usually have very viable returns, much better than doing maybe a bullish. You might sell if you were bullish, but it didn't look like it had very big upside. You might be much better off selling a put spread versus buying a call spread. Because usually on that selling the put spread, the price may not even have to move positive to make the return that you already put in your pocket. SLDB. Observe the obvious. When it got up to the 200, doji, 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 back below the T line, where do you think the next likely target could be? Back down here. The moving averages, Jess, is the blue and the red. This is a simple 50-day moving average. This is a simple 200-day moving average. The T line is the 8 exponential moving average. The reason we call it a T line is if you see a candlestick buy signal and a close above the T line, you can stay long until you see a candlestick sell signal and a close below the T line. But again, with the caveat that the further away you move from the T line and you start seeing a sell signal, more than likely it's going to come back and test the T line. So this gives you that much quicker analysis of when to take profits. So here's another bearish doji sandwich on GBT. If it opens lower tomorrow, where do you think the next likely target is? Right, at least coming back down to fill the gap. So you can always use what everybody else uses for their support resistance. We just have that much better capabilities of seeing where a target might be, because that's what everybody else is watching, and being able to see what type of signal or pattern is telling us we're probably heading back to that direction. Oh, I forgot to do the biggies. Tesla had a big morning star signal, kind of a scoop pattern. And Western Digital also might be doing a J-hook pattern. So if this opened positive tomorrow, what would you have going? Like a doji sandwich, meaning you could move up this much. Now remember, tomorrow is expiration day for the September 27 calls or puts, which means if you're really aggressive, if this opens positive tomorrow, and I'm going to just pick out let's say the 62 calls are trading at 30 cents. Well, if it has another big day, maybe by the end of the day, that 30 cents is turned into $1.20. Just because you can see exactly when that price move is happening right at the exact time, like we saw today on SPWR. Oh, traded lower, okay. Probably earnings, I would imagine. That's the other criteria, too. If it's trading down here somewhere, then that means it's not going to work as that trade. Oh, Micron Sympathy. Yeah, I don't know where Micron was trading. I think it was trading down in this area after hours. So some of the other biggies. If you're trading Apple, this is why the analysis of based upon the charts tell you this one's not going anywhere. Sideways. Amazon. Still rolling over. You can see how it didn't support here. This is the advantage of seeing what type of investor sentiment. Over here, we had a doji right on the 200. Had another little kind of a hammer signal. Told us it was supporting. Over here, that candle told us there was still very strong selling as it went down through the 200. NVIDIA, after hours, was trading right about in here. However, remember, after hours doesn't mean a whole heck of a lot. It's where the price or the futures are trading right 10 minutes before the market opens. That's where everybody's putting in their orders. So if this one opened positive tomorrow, doing a kind of a doji sandwich, we might expect a move like this. Well, Tesla, you've got pretty much a Morningstar type signal, scoop type pattern. If it opens positive, and especially if it broke through this area, I would suspect it's going to pop back up to the 200-day moving average. Netflix, nothing there. And Facebook, we bought puts on this one because look what happened right smack dab here at the 50. There was your doji. And if you just use the simple doji rule, and it opened positive, what did we have? We had kind of a bobble breakout. In fact, they opened it lower and closed down here. What that tells us about the 50. So it's still acting as a resistance level and closing below the T line. It was time to start shorting. Remember, if it failed here at the 50, kind of is a blue ice failure, where do you think the next likely target's going to be? Down here at the bottom of the pond. Okay, are there any general questions on candlesticks? JP Morgan, I'd probably be more apt to go short on weakness tomorrow. And Marna, same scenario. When was it time to get out of this uptrend? You saw a candlestick sell signal and a close below the T line. There's your bearish left-right combo. That was your warning. A left-right combo is much more relevant, much more, Jesse, if you scroll up, you'll find his text. A left-right combo is a much more stronger warning because anytime you see a doji involved in a multi-day or a multi-time frame pattern, that's a little bit stronger than just seeing a bearish engulfing signal. Would the left-right combo have been a good short entry? The fact that it opened lower and traded lower, yeah, I would have probably started shorting it there. When it did a doji, what do we know about our doji rule? If it opened lower the next day, you could definitely be shorting it because you got a bearish doji sandwich in progress. And then what was the results of the bearish doji sandwich? Obviously, much more downside. Where's your next target? The 50. Hold on to your individual requests. What is the difference between a fry pan bottom and a fry pan bottom in an uptrend? I usually consider a fry pan bottom at a bottom of a trend. It's usually a big rounding trend. I'm trying to think of a which one? This is more of a what I would call a slow curve J-hook pattern. This is what I would consider a fry pan bottom, the bigger bottom or bigger fry pan. I'm trying to figure out which one. If it's the opposite, this is called a dumpling top. A slow curve to the downside. J-hook versus inverted J, nothing. One's a bullish J-hook, one's a bearish J-hook. Ernie, that I don't know. I use Metastock. I use TC2000. You can also use the scanning tech abilities on Thinkorswim. I like Thinkorswim because I can trade stocks, options, futures all out of the same account without having to move money back and forth. Then if you want to, you can use their scanning softwares where we've got some of our formulas set up already, like the left-right combo. You can, all you do is click on it and it finds them for you. Okay, Finn is very. This is the advantage of our chat room every day. Is that type of question is much better because I don't know. I'm an old dog, so it's hard to teach me new tricks. So I'm using what I've used successfully for years. So that same question in the chat room during the day you can say, all right, what's the best scanning softwares or what's the best trading platforms, and you've got 120, 150 people in there that can give you their opinions. OT tomorrow is my birthday, and I only mention that because I want you all to send me presents. What criteria did you use to scan tonight? I've got a very simple scanning process because I can recognize the signals and patterns immediately. I'll just send money. So I can do a scan looking for the biggest percent move on stocks today and be able to recognize, oh, that's my best friend. So I can do my scans, and that's why we teach people to do their own scans, is because when I put out 2 or 3 stock picks every day, maybe they don't open correctly. So instead of being stuck with looking at my picks that didn't open correctly, when you know how to do your own scans, you might have another 6 or 7 more that look good, that one of those or 2 of those are opening as anticipated. Okay, checks in the mail, good. Okay, let's go ahead and do the double line. And in 3.2 seconds, do the next double line. Procter & Gamble is about as dodgy a stock. It's in a slow, steady uptrend, as you can see. All you can do is stay long on this one. Home Depot, J-hook pattern. Also notice what type of signal we had today, which makes this very simple. If it opens positive, you want to be buying because you can see the J-hook pattern setting up. SPWH, there's your J-hook pattern. Look at your bullish engulfing. There's your bullish confirmation. There's your doji sandwich. There's your breakout level. So if this opens positive tomorrow, what do we expect for a continued uptrend? Wave 1, wave 3. Gold, let's see, we'll take a look at the, what is this? September gold. Gold is backed off. Let's see what other gold. The October gold. So gold is just kind of hovering in here. SIA. The silver also just kind of hovering in here. Not really any good great trends. ConAgra. This one has broken out above this level. If it opens positive, you can be buying this one. EBYL, that's not working. Is it EBYI? That doesn't look like it. The diamonds, same as the Dow, just sideways. Would not be trading the indexes right now because there's no direction to them. Bullish engulfing signal on, is this night transportation? You can be buying this one, J-hook pattern in progress. U.S. Steel. No, I wouldn't be short this one because you're getting toward the oversold area and you're nuzzling the T-line. If you were short, you should have covered it by now. You're seeing buying. That's what the green candles are, right at the same level it bottomed out before. And Macy's, you can stay short on this one as long as it doesn't close above the T-line. Notice your little kicker signal that gave you the force to the downside. Now, probably if you're short, you can stay short, but if it opened positive tomorrow, I'd cover it, but I probably wouldn't be long or short this one right now. SHB, that's one, I don't know what's wrong with that one not coming up. Whoops, I lost my place. Rambus. You can get ready to buy this one on positive trading and then just use the T-line as your stop. Beyond Meat. Gapped up today, but it opened here and closed down here. Still probably wouldn't be one that I'd want to trade until you see the profit taking stop and then the buying starting again. So you're basically looking for a indecisive trading day and then the price to move up. That's your message. EMOS, I probably wouldn't be long or short this one right now. Wouldn't be long, but wouldn't necessarily want to go short because of the trend. And CLDR, another one. I wouldn't be long or short, just not moving anywhere. DYI, we did that one, right? Yeah, wouldn't be long or short this one. Going absolutely nowhere. Crude oil. Let's see. This one, no. L X L A X. Crude oil is stuck right here in this range. Another one that if I was short, you could stay short, but you can see how it's starting to support here at the 50. TBI, slow uptrend. You can stay long. You're looking for it to break out through here. That one. So if you're long, you stay long. You just don't want to see it close back below the T-line. Tiffany's. Another one that I probably wouldn't be long or short. If you're short, it needs to get, I wouldn't want to see it come back up through the T-line. You can see how you're starting to show some buying in this area. Another one that needs to come back up, use the T-line as your stop if you're long. Or if you want to be a buyer, if it comes back up through today's open, that's when you can start buying. Keurig, nothing. You can see that you're stuck in a wedge. I wouldn't be long or short this one right now. It would definitely have to break out through this level. I'd probably want to be more apt to pay 28 for it, knowing that it broke to the upside. X. Nice J-hook. Stay long on this one. This is your classic. There's your fry pan bottom. J-hook. Notice your morning star signal right smack dab on the T-line. Oh, Green Bay. All right. That's right. If I can't figure out. That's not much of a bucket list. Right. Okay. All right. Our problem right now is because of all the rhetoric going on in Washington, we don't have any direction in these markets. But there are some good stocks. We've already recommending this one on positive trading tomorrow. And BC, on positive trading, giving you the J-hook pattern starting with a belt hold. Micron, with it trading down here, you could, it might have been all the way down here. So, and here's a good example that as soon as it closed below the T-line, you should have been out of this trade. Anytime it closes, the price closes below the T-line, your probabilities to the upside have greatly diminished. So Apache, if I had been long up here, I would have definitely had my stop at where it opened, because logic says if it comes back down through there, the selling has started. Okay. And Zoo, little Morningstar scoop type pattern. Look for a slingshot effect. Okay, everybody. We'll see everybody bright and early in the chat rooms tomorrow. We'll see you then.